Hey everyone, welcome back to the channel. What if I told you a brand new tax bill could increase your refund, boost your credits, and actually lower what you owe starting in 2026? Sounds too good to be true, right? Well, a major new tax proposal just dropped in the House of Representatives, and it could seriously impact your finances. We're talking everything from standard deductions and business tax breaks to estate planning and family credits. And yes, it's already making waves. So let's break it down, no politics, just the facts. Who could benefit, who might not, and what you need to know before the headlines take over. On May 9, 2025, the House Ways and Means Committee introduced a sweeping new tax plan. While it doesn't have an official name yet, it's been casually dubbed by some, including former President Trump, as one big, beautiful bill. Its main goal? To expand and extend many of the 2017 Tax Cuts and Jobs Act, TCJA, provisions, which are currently set to expire after 2025. The idea is to keep take-home pay higher, tax bills lower, and the benefits of the TCJA alive well into the future. But there's a lot more under the hood. Let's break it all down, starting with the standard deduction, because this part affects nearly everyone. 1. Standard deduction as of 2025. Single filers get $15,000 heads of household, $22,500 married filing jointly, $30,000. These figures are from the 2017 tax cuts, but they're set to expire in 2026. Without action, those deductions could shrink dramatically. Singles could drop to around $8,000 to $9,000 heads of household, around $12,000 to $13,000 married couples, around $16,000 to $18,000. That means a bigger chunk of your income would be taxable. The new bill solves this two ways. 1. It makes the TCJA standard deduction permanent. 2. It gives a temporary bonus from 2025 to 2028. Singles and heads of household get $1,500 more, married couples get $3,000 more, so the revised standard deductions would be $16,500 for singles, $24,000 for heads of household, $33,000 for married couples. 2. Child tax credit. Currently, it's $2,000 per child, and that number hasn't changed since 2017. It's not even adjusted for inflation. Here's what the new bill proposes. From 2025 to 2028, the credit increases to $2,500 per child. Starting in 2029, it returns to $2,000, but with inflation indexing, meaning it'll grow over time to keep pace with the cost of living. The eligibility rules stay the same. Your child still needs a valid social security number. 3. Bracket creep fixed. This one's sneaky but important. Right now, tax brackets adjust for inflation using something called chained CPI. It assumes you change your spending habits as prices rise, like switching from steak to chicken. But because it rises more slowly than regular CPI, it causes more of your income to be taxed at higher rates over time. That's called bracket creep. This bill would switch back to regular CPI, helping tax brackets better keep up with real inflation, and saving taxpayers money in the long run. 4. Estate and gift taxes. The current exemption is about $13.9 million per person, a record high. But it's set to shrink in 2026. The new bill increases the exemption to $15 million per person, makes it permanent, indexes it to inflation going forward. It also aligns the generation skipping transfer tax, GST, with that $15 million figure, helping families pass on wealth to grandchildren or beyond without steep tax hits. 5. Business taxes. Big changes here too. The bill permanently extends the 20% deduction for qualified pass-through entities like LLCs, partnerships, and S-corp. Keeps the corporate tax rate at 21%, instead of allowing it to climb back up. This is a major win for small to mid-sized businesses, especially in fields like real estate, law, and healthcare. 6. SALT deduction cap. Before 2018, there was no cap on how much state and local tax, SALT, you could deduct if you itemized. The TCJA capped it at $10,000, and it's still there. That's a problem for people in high-tax states like New York, California, or Illinois who pay way more than that. The new bill proposes raising the cap to $30,000, so if you pay $24,000 in SALT, you can deduct the whole thing. Not just $10,000, but keep in mind, this only helps itemizers in high tax areas. Most people who take the standard deduction won't be affected, and it's controversial. Critics say it helps mostly high-income households. Pros versus cons. The pros: higher standard deduction and child tax credit equals more money in your pocket. Fixing bracket creep helps fight hidden tax increases. Estate tax changes simplify legacy planning. Businesses get long-term tax relief. SALT cap increase helps high-tax state residents. The cons: it could reduce federal revenue by $4.9 trillion over 10 years. Lawmakers have floated cuts to Medicaid and clean energy programs to make up for the costs. Some low-income families may see limited benefit if they don't qualify for the full credit. SALT cap changes still leave room for debate. So, what's the bottom line? Is this a massive tax break, or just a short-term win with long-term consequences? That really depends on your income, family situation, and how you feel about trade-offs like the national deficit or public program cuts. But one thing's for sure: as we get closer to the 2026 TCJA expiration date, this bill is going to be at the center of a major tax debate. Let me know, would this bill help you? Or not change much at all? Drop your thoughts in the comments. If you found this helpful, give it a like, consider subscribing, and feel free to share this video with someone who might benefit from it. Thanks for watching, and I'll see you in the next one.